How's it going, everyone? My name is Dan, but you can call me Malone, and I think we can all agree that 2021 was a crazy year for investors. Records were shattered, more money than ever before was being invested, and the next class of millionaires were being minted from unconventional investments. As we draw closer to the end of 2021 and to the beginning of 2022, let's take a look back at some of the moments which shaped the investing landscape of the last year. But before we do, if I could ask that you take just 2 seconds out of your day to leave a like on the video, and if you are new around here, don't forget to subscribe. WallStreetBets. What was already an iconic Reddit community whose members show little regard for stock market fundamentals or anything for that matter that isn't all-in YOLO call option gains, obtained worldwide fame in 2021 over what will go down as one of the greatest short squeezes of all time. So what exactly happened? In short, the folks over on the WallStreetBets subreddit proposed a devilish investment in GameStop stock, which, if successful, would see them strapped into an Apollo 11 remake accompanied with a one-way ticket to the moon. Choosing GameStop as the target was no coincidence, rest assured, as the subreddit noticed that GameStop stock was heavily shorted, particularly by big-time US hedge funds. When you short a stock, you're hoping that its price will go down and not up. Because GameStop was so heavily shorted, WallStreetBets proposed that if they all came together and bought lots of GameStop stock through call options and direct purchases, they would be able to increase the share price. This would cause individuals who had shorted the stock to lose money and force them to buy back the shares at a higher price in order to cut their losses, which would increase the price even further, causing a feedback loop of exponential price growth. And WallStreetBets were correct. GameStop stock hit highs of $325 and still to this day is much higher than pre-squeeze levels. Large hedge funds like Melvin Capital were forced to close their short positions at massive losses, further fueling the gains. Unsurprisingly, this caught the attention of the world, and all eyes shifted from cryptocurrencies to shorted stocks. Many praised WallStreetBets for their communal spirit in taking on the big hedge funds, and for giving the average Joe the ability to see green in a big way. And it didn't just end with GameStop, as the eyes of investors turned to other heavily shorted stocks like AMC, Macric, and Bed Bath & Beyond. The plan once more for WallStreetBets was simple: buy. For these guys, it simply did not matter. Remortgage the house, borrow from the in-laws, sell the dog, anything you could do to get your hands on more cash to buy more and more stock. AMC got the most attention from investors after GameStop, returning just over 900% in the month of January. These kind of short-term gains were unfathomable, and WallStreetBets seemed to be unstoppable. At least that's what we thought. It wasn't before long that brokers started putting restrictions on trading these stocks. Robinhood received by far the most media attention, as it prevented users from investing in GameStop, AMC, and BlackBerry stock. But yet they kept the sell button enabled, and there were claims of blatant market manipulation by Robinhood in favor of the wealthy hedge funds who were bleeding cash. Many well-known individuals took to Twitter to share their outrage at the broker, whose very name suggests that they be in favor of the little guy and not the big hedge funds. Robinhood later came out and said that they made the restrictions on the back of liquidity concerns, due to the fact that many of their users were investing in GameStop using margin, which is effectively cash borrowed by the investor from Robinhood. Investing with margin can be very risky in times of high volatility, not only for the investor but also for the broker. But if that's the case, Robinhood should have had tighter margin requirements in place to prevent something like this from happening. All in all, this event really was one of empowerment to the retail investor. The point was made that the little guy can, with the help of some like-minded individuals and a bit of coordination, make a big splash in the financial markets. In fact, such a splash was made that Robinhood CEO Vlad Tenev, as well as WallStreetBets legend Keith Gill, aka Roaring Kitty, were called to a hearing led by the House Committee on Financial Services to give congressional testimony on the event.
A few things I am not. I am not a cat. I am not an institutional investor.
Special purpose acquisition companies, aka SPACs, gained worldwide attention in 2021. A SPAC's purpose is to raise money through an initial public offering or IPO with the sole purpose of acquiring an existing company. Oftentimes, this is done to bring a private company into the public domain as fast and efficiently as possible. Most recently, FaZe Clan announced plans to go public using a SPAC, which would value the esports company at $1 billion. SPACs were all the hype this year because, for the most part, they were subject to rampant speculation, or speculation as I like to call it. Take the Churchill Capital and Lucid Motors deal. The market had been speculating that the SPAC Churchill Capital was in talks to acquire Lucid Motors, who are a luxury car company specializing in electric vehicles. In 2021, all it took for some manic price inflation was the two words electric and vehicle to come together in the same sentence. I mean, you only have to look as far as Tesla to see the hype backing these companies in recent history. Anyway, needless to say, the market was very excited about the potential acquisition, as Churchill Capital soared over 478% in 5 weeks. And to the joy of investors, the deal was officially confirmed, which sent Churchill Capital soaring another 500% in 24 hours. Just kidding, it actually plummeted by 55%. This is the downfall of SPACs. SPACs are renowned for their price rallies during the time when there's speculation over who they might acquire. But once the target company is actually announced, stock prices suffer. Research from Bloomberg shows that SPACs have performed much worse than traditional IPOs on average since 2018. In fact, a SPAC index of 25 companies underperformed the S&P 500 by more than 50% in 2021. So even amidst a sea of negative statistics, SPACs are continuing to attract investors who are looking to make a quick dollar, and this is why it's worrying. According to the research paper SPACs Insider IPOs, SPACs raised $87.9 billion in the first quarter of 2021, more than the total raised in 2020 combined. Many SPACs in 2021 were backed by celebrities. Shaquille O'Neal, Serena Williams, Jay-Z. 21 out of 33 SPACs backed by celebrities posted negative returns in 2021. Only 2 of these SPACs returned gains in excess of 10%, far below the returns of the S&P 500. But here's what's even crazier. As the number of SPAC deals has increased, so too has the number of investors asking for their money back when the acquisition actually happens. So for the most part, everyone is aware that these investments are short-term plays. The investment bankers make tons of money along the way, and the average shareholder is left holding the bag. Looking forward to 2022 and beyond, SPAC-mania has likely only just begun, with companies like Lucid Motors now being investigated by the SEC, and with the poor performance of SPACs as compared to the broader market, most investors should just steer clear of SPAC deals going forward. 2021 was a crazy year for cryptocurrencies and blockchain technology. Bitcoin advanced by over 140% between January 1st and November 8th, but has since collapsed by nearly 30%. But Bitcoin wasn't the frontrunner for 2021. At the beginning of the year, we seen Dogecoin change the face of the crypto landscape and attract investor interest from nearly every corner of the globe. The meme coin rose by nearly 20,000% between mid-December 2020 and May 2021. The frenzy was supported and likely caused by none other than Tesla and SpaceX CEO Elon Musk, who regularly talked about the crypto on his Twitter. But Dogecoin was only the prelude for the main act. The real winner of 2021 was Shiba Inu, which between its launch on the 1st of August 2020 and its all-time high on the 27th of October 2021 returned over 17 million% in gains. This kind of return would make you a multi-millionaire from just a €100 investment. These kind of gains were truly unprecedented and highlighted the power and mania of retail investing. However, since Shiba Inu's market cap cap peak at over $50 billion, it has declined by well over 50% to just over $16 billion in market capitalization. The same can be said about Dogecoin, which has fallen by over 70% since its peak. These events have birthed a new investing culture with its own mascots, terminologies, and ethos. Perhaps the most interesting development in this space was the emergence and popularization of non-fungible tokens, aka NFTs. The hype around NFTs is centered around owning one-of-a-kind digital assets. Blockchain technology allows us to make any form of digital media unique and one-of-a-kind, from artwork and music to photos and videos. Perhaps the most popular NFTs in 2021 were the CryptoPunks collection. This digital ensemble of 10,000 was created back in 2017 and is held on the Ethereum blockchain. As of recording this video, the cheapest punk on sale is going for just under 60 Ether, which equates to over $220,000. In fact, the total value of all punks sold in 2021 is over $2 billion. High-profile figures like Logan Paul, Mr. Beast, and FaZe Banks are known to own some of the collection, with proponents like Gary Vee going on record claiming that NFTs are the future. The most famous NFT sale of 2021 happened in March, where artist Mike Winkelmann, aka Beeple, sold his piece Every Days, the first 5,000 days, for $69 million on auction. Winkelmann then went on to appear on the Joe Rogan podcast in December. Talking about NFTs, Ethereum's founder said that he thinks NFTs have been interesting from a cultural perspective because they're bringing people into Ethereum that have a completely different mindset than DeFi and regular crypto people. So what you have again is a cultural movement towards this new asset class. Looking forward to 2022 and beyond, and it's honestly very hard to say what the cryptocurrency, NFT, blockchain space will bring. But let me know what you think. Outside of short squeezes, SPACs, and cryptocurrencies, it was an insane year for the broader market. More money was invested in stock funds in 2021 than the combined total of the last 20 years. That comes out to nearly $900 billion invested in one single year. By April 2021, stocks had gained $22.4 trillion in value since the crash of March 2020. Bear in mind, all of this was happening at a time when inflation was hitting rates not seen for decades, our global supply chains were facing unprecedented crises, and new variants were on the rise. The S&P 500 alone has returned over 23% in gains to investors in 2021, well above its historical average annual return of 10%. The question is whether or not this performance will continue into 2022 and beyond, or are we set for some lackluster returns in the future? The key factor here is going to be inflation. To make a long story short, we've lots of money circulating in the economy and we've lots of demand for goods and services, but we don't have the supply to match that demand. This has led to prices increasing. For example, in Ireland in 2021, transportation costs are up by 16%, primarily because of higher prices for vehicles and petrol. The powers that be will likely increase interest rates to reduce the inflationary pressure on the economy. This makes borrowing money more expensive, therefore reducing the amount of money available to buy things. Generally speaking, rising interest rates will lead or should lead to falling stock prices. The price of any stock is calculated as the present value of the market's expectations for future cash flows. The present value of these cash flows will fall as interest rates rise. Therefore, for a stock to maintain its current price, the market would have to increase its expectations for future cash flow, which may or may not be feasible. If expectations aren't increased, then stock prices will fall. Now, obviously, we can't predict the future, but US officials have said that interest rates could rise as early as March 2022. Beyond 2022, there's expectations for further increases in 2023 and 2024. This uncertainty is exactly why I'm a long-term investor. Nobody knows where the stock market is going to go today, tomorrow, next month, or next year. Likewise, nobody knows what the next GameStop or the next Shiba Inu is going to be. By making investments which make sense in the context of your own personal circumstances and holding those investments for decades, you can block out all of the noise in the short term. If 2020 and 2021 have taught us anything, it's to expect the unexpected. But but I'd be curious to hear what your investment plans are for 2022 and whether they include any of the assets which we've discussed in this video. So I really do hope you enjoyed the video here today. As always, if you did enjoy the video, please do let me know in the comment section below. Leave a like on the video, subscribe to the channel, and I'll see you in the next one. Cheers.